Alright guys, so I'm going to be diving into all of my positions for this month so far, which have been 3 trades, all of which were taken last week. Euro pound was the first position on Monday, which took me out for a 1% loss. And then we had dollar CAD on the Tuesday, which took me out for a 10% win. Then we also had Kiwi Yen closing off the week at 3.5% profit on that trade. Now, I want to make something clear. We don't put a limit on how many trades we should take or shouldn't take. Falcon's philosophy from day one has stayed the same, that if as long as a trade meets your plan and it's high quality, you take the trade, whether there's 10, 15 or 100 of them in a week, does not matter, right? Now, normally it ends up being 1 trade in the week, sometimes 2, 3 is a bit out of the normal, that's fine. But we're not placing emphasis on that. I think trade frequency is a topic that's massively over exaggerated and misunderstood. I can understand why, because a lot of you guys may trade 1 market or 2 markets at most. We're very fluid with how we trade. We don't have to be tied to 1 pair or 1 instrument or 1 time frame or 1 session. We're involved in FX, commodities and indices and all different instruments. So I can understand why, but trade frequency, in my personal opinion, is a massively over exaggerated topic. I think universally it should be that regardless of how you trade, as long as a trade meets your plan and it meets your criteria and it's a high quality setup within that, take it. Do you know what I mean? Otherwise that'd be avoiding the very premise and law of probabilities. It doesn't make sense. I can understand people's notion as to, and again I've said this over and over again many times over for those who listen to my content, that don't just take a trade primarily because it fits your plan. There's got to be an extra layer to that as to, is it now a higher risk setup that you've got in your plan, or is it a lower risk version of a setup that you've got in your plan? Right? I only have 2 setups in my trading plan. That is it. And I trade those 2 setups universally across different markets. Now, I don't take every single trade that just fits my plan, because there's a higher risk version of a setup that fits my plan and there's a lower risk alternative. I'll show you a quick example before I dive into the trades. If you have this setup and then you have this setup here, so both of these are examples of 2-touch bear flag continuations. One of them, let's call it A and B, is higher risk than the other. A is higher risk than B. Both of these, if I was to take the entry here and here, both of these entries fit my plan. However, one's a higher risk entry compared to the other, which is A, because we're sat beneath a hook point / liquidity range, or liquidity point. So the chances of me getting tagged in and tagged out here are higher. So the way that we tackle that is if I've got the capital to, in quotes, afford taking the higher risk position, meaning if I'm in a slight bit of profit, I've got that buffer to afford what we label as more expensive positions. If I'm in drawdown, this is not the kind of position that I want to be taking. Now, a lot of you may look at that and think, well, what if you were down -1 or -2% and you decided not to take the trade because it has a higher risk and that trade goes on to make 10%? Well, simple answer. An exception does not make a rule. What if it didn't play out? Now we're playing with probabilities here. You want to give yourself, as a probabilistic trader, the highest possible chance of winning, especially when you're in drawdown. So what if a trade happens to play out? You can take a poor quality trade and it can still play out. It doesn't mean you did the right thing. Again, it's another topic that's so misunderstood, which is what is right, what is wrong. There is no such thing as right and wrong in the markets. The markets move literally based off of interpretation. Putting aside all the volume and order flow and all the fancy stuff that you guys know, I'm not talking about that. In essence, fundamentally, the imbalance in orders that are coming into the exchange are literally primarily due to a differentiation in opinion as to when to buy and when to sell. If everybody had the same bias to sell at the same time or same bias to buy at the same time, the markets would just be going one direction forever, or they would flatline. It doesn't make sense. Everybody has to have a differentiation in opinion, and that's fine. That's actually how the markets move, and then obviously there's volume to push that in either direction, regardless. So I'm looking at this position thinking, right, it's higher in risk. I'm not taking it. I don't care if it plays out. I want to give myself the highest possible chance of winning. So what if the next trade I take is lower in risk and that happens to be a loss again as well? But that's not, the independent trade is not going to be what gets you further ahead in trading. It's the decisions behind the trade and the consistency in the decisions that you make behind the trade that cause you to win over a period of time. That is it, not the individual setup. 1 trade, 2 trades being a winner or a loser does not mean anything. Even a losing month does not mean anything. A trader can come to me and say, I've had a fantastic month, I've made 50% return. Okay, that doesn't mean anything. You could be the worst trader on the planet who can't even trade Pokemon cards, but you've managed to make 50% return in that month. I want to look at the decisions that led you to take those trades. Are they profitable decisions, yes or no? that's going to determine whether you're a great trader or not. Not what percentage return you made. It's absolutely nonsensical to me. So that's just a quick example for you there. But regardless, let's dive into the technicals. So first position, euro pound, which was taken here. If we look at the higher time frames, what we've done is we've tapped into daily lows at 85 470s, and it's the way that we've come into it. So what's happened is we've broken this structure, we've formed continuation to confirm the change in sentiment, and we've followed through with that momentum. Then we've exhausted here in a specific way. Now this video will highlight to you that if you Google chart patterns and then you try and understand how we trade, there is a massive difference, and you will see that. So we've come into here, typical descending channel, as you can see there, showing exhaustion. We've had multiple continuations on the way down, 1, 2, 3. We've eventually formed this. We can remove the daily lows now because we know where we are. Now if we add this on here, as you can see, what has price done? It's come through, it's broken below, it's got people caught on the wrong side in the market. It's tried to commit. I was looking for continuation here, we didn't get that, so that's failed attempt number 1. It came back below, tapped into this area again where there's volume clearly. It then pushed higher, failed to commit by not forming continuation again. Where did it react to? It reacted to the top of this channel, which is so repeatable, very, very repeatable price action. Now I'm playing this intraday range. So as you can see there, how has it also led into that area? Look how it's formed this structure with the 1, 2, and then the 3. As you can see there, very, very lovely. Now this is clearly the reversal point that I'm looking to aim towards, and anything between that is more of an inflection point for management of my trade. We've then come below, we've formed this continuation 1, continuation 2, and now continuation 3. Sequence wise, this is stunning. So the reason why this is better than, say, for example, the first continuation here is because we're right at the bottom of the sell move. So we need more deliberate price action. Right? So if that means being further down sequentially here, then so be it. And that makes way more sense, and that actually increases the quality in the trade. Even though they're both the same setup, the positioning is different. Positioning is everything in the market, so you want to get yourself positioned correctly. So another point to mention here. Now, when we're looking at this bear flag continuation, it looks very simple, right? If we go back here, and this is one thing people don't understand about wicks and pin bars within these structures. So we're looking at the 1 hour time frame here. Imagine if this had just wicked through the structure like so. If we were to then go onto the 15-minute time frame, that wick would represent a 15-minute bullish candle break and then bearish retrace back in. And a lot of people would think, oh yeah, that meets my plan, let me just take the trade there. But what they don't realize is time frames have to be used sequentially in order. There's a particular art to using time frames. Okay, so they would see that, and then what happened is on the 1 hour time frame, the next candle, say if it closed here at the body, could be this, and it breaks and closes out, and then you take a loss for no reason. So it could do that, and then it could follow through and just not give you the entry. Or it maybe will fill the candle, fill the wick, just about keep you in and go. Still doesn't mean you did the correct thing there, or the most effective thing there, let me rephrase. So instead what I'm waiting for, and I've experienced that through live trading, live experience, I've not tested this, through live experience, through taking loss after loss after loss over a period of time, I realized through thorough self-assessment that actually wait, there's a more effective way to do this. Wait for the candle to close or fill the area first, which we've done there. We've closed at the edge of structure there, and then we have this retrace candle. Now, there's a particular way I play this. If I come down to here and I find, right, with sufficient stop protection, am I getting a feasible risk to reward? I know generally what risk to reward I need to be getting for this kind of range of movement. And so I wanted to get a slightly tighter entry because I wasn't happy with the risk to reward there for the range of movement that we were moving. So I thought, all right, I'll set a limit order entry, 50% limit order on this candle here, which is very rare that I do that, but for the sake of the structure I did. Got in with about 7.5, 8 pip stop, which again is a lot lower than normal. The lowest we usually go is 10 pips, but there's certain scenarios where going slightly lower makes sense because a stop loss is an invalidation area. That's all it is. So if price meets that area, is it invalidated? Yes, because for it to meet that area, it'd have to break or close outside the structure. And this is the final line in the sand for the 2-touch continuation. If this is going to form into a 3-touch, we'd have to break down to here and form this, by which point I can eliminate my risk anyway. So from a financial risk management point of view, it makes sense. And this has completed the structure. It's filled at the edge. It's done everything I needed to. and then this was a very quick loss. Nothing I can do about it. And then it happened to drop off. Am I going to look at that trade and think, oh, I could have done something different? No. Simple trade, job done, moved on to the next. So the next position was actually the day after on dollar CAD. And this was a long position, which was taken here. So let's rewind it back just a little bit before the trade. Let's go to the higher time frames. This is so clear. It's ridiculous how clear this is. So if we look at this from an impulsive move from point A to point B, and we look to add that onto there, from an impulse correction and impulse point of view, look where that taps into. That taps into this region here. Why is that important? Well, when we actually tapped into this range here, created all-time highs, or tapped into all-time highs, sorry, pushed lower, formed our first consolidation, which is this massive volume accumulation, and we dropped through. That's when we started to have the continuations. That's where we started to have this downtrend, if you like. Now, where's price leading back into? That same area of volume again. So from a higher time frame point of view, this makes clear sense. But putting all that aside, this is a very clear continuation. Simple as. So if we look at this from this point here, and then we dive in like so. Look at this. Impulse, correction, and impulse. 1, 2, 3 finishing move. Exhaustion all the way down. And now we've accumulated here. So looking for longs makes complete sense. There's no real area of value beneath. I mean, there's one inflection point, but it's all the way down here, so it's not relevant. We can take this off because we don't need it. So we know we've clearly tapped back into these lows. We've broken back into and above these lows now. Back past 1,322.80s. And the second part to reconfirm that is that we've also broke with a channel 1, 2, and 3, and then we've broke past that. Now, if this was going to turn back down from here and form a larger continuation to sell off instead, which can be an opposing pattern, which is possible, it would have done so once, twice, 3 times, but it's not. So the failure in commitment at the downside from that area is solidifying the long position for me. So if I just draw through this, you'd have to cut through the wicks on this one because I'm playing the hourly structure here. There's a little bit of news there as well. So I'm playing the 1 hour structure, which is why it's important you know your time frames. So as you can see, there you go, we react. Now, what are the chances of this forming a bear flag continuation to go lower? If we've got all of the confluences met that I've explained, very low. So as you can see, it starts to consolidate sideways. Now I can see that on the 15. So I'm refining the entry in the 15 minute, but I'm playing the 1 hour structure because this looks like a mess on the 15 minute. If I was to be playing this on the 15 minute, I mean, I wouldn't even know where to add the structure on. It just looks like a total mess. That's why I'm playing the hourly structure, because we can see it there. So why do you need to go lower to the 15 minute or 5 minute to see a structure that you can clearly see on the 1 hour/4 hour time frame as well, as you can see there. So I've got the 1 hour structure intact. Now I'm playing the 15 minute entry. Okay, so within there, this is a bit more of a what would be, I would say, to an inexperienced trader, but a bit more of a messier entry. But you can see the trade regardless. So we've got, actually, this is developing a bit more. Right. So you can see the actual structure form there. There was the entry. This triggered me in. So let me just pause this and pull my phone out so I can get the exact entry. Bear with me a second. Right, so the entry was at 132,230, which was here. Yep, so this was a limit order play as well. And the stop loss was at, yeah, it was about here. So I had about a 6.97 pip stop. We'll just put it at 7 for the sake of it. So there's a funny story behind this trade. I took this on both of my accounts, one on a funded capital and one on personal capital as well. On my personal capital account, it kept me in because it didn't go into any drawdown, as you can see, like literally by 2 pips. But for some reason on my funded account, my margin had maxed out. And I didn't realize that my lot size that I'd placed was too big. Even though it added up to the same monetary risk, it ended up using the required amount of leverage. Sorry. So I stayed out of that trade on my funded account because it tagged me out for like a 2 pip loss, which was 0.1% loss or something along those likes. And then on my personal capital, it kept me in. It is what it is. It's never happened to me before, ever. I've never had this issue in the past 7 years. And obviously something I wouldn't even think about. And so I got triggered into the trade on both accounts. One kept me in, one didn't. It is what it is. But still managed to stay in on personal capital. And the trade happened to be very, very easy in terms of management. I'd break even around about here, as we can see. And then obviously price was rocketed. So there's nothing complex about this trade at all from top down. And the trade happened to have closed around about there. So just under 10%, as you can see there. So as we were running about, 11 a.m., I knew looking at this that we've already broken past this point in structure. And this is very likely to either trickle around here for a bit before it drops off and pulls back. Because if there's one point it's going to pull back sharp or turn around, it'll be the top of the structure. So I want to be getting out here and not holding through that. Or I can sacrifice a couple of percent and lock in profit at 8%. But I thought, you know what, I'm going to be busy for the rest of the day. That Tuesday was very busy. I'd rather just get out the trade, take my profits and walk off. And so I did for about 9.9, 10%ish. And then obviously it did turn around from there. Later on it did carry through, but realistically, are you going to manage through all of that? Are you going to look back at that and say, oh, I should have locked in 2.4% and really tell me that you would have sacrificed 7.5% worth of profit? It's silly. So never ever look at things in hindsight in that sense. That was a simple trade. So trade was there on the 15-minute time frame, as you can see. You can even see on the 5-minute, but I was placing more emphasis on the 15-minute structure there, only because we didn't have a strong push back in. So I'd rather have traded the 15-minute as opposed to the 5-minute time frame structure there. So that's simple. And then the final trade, which is a Kiwi yen short position, which was taken here. So if we look at the dailies, I mean, this is just so clear from top down. It's ridiculous, especially when you know what you're looking for. So we've clearly got this larger daily channel here, as you can see. And then right at the top of that, even if we scroll left, you can see the weekly value area is so high up, there's nothing on the left of it. So this is actually responding to, it's broken past this. Boom, 1, section 2, section 3. It's broken outside of this. It's in sort of the grey man zone, if you like. And what it's done is it's got people caught on the wrong side. It's clearly exhausted. This is not in the state of a continuation, because it's gone from, and this is the key observation, impulse, correction, impulse, larger correction, straight into a larger correction. That doesn't happen sequentially when it's in the state of a continuation on the higher time frame. After we've had that larger correction continuation, we'd normally have a tighter one, and then we'd follow through. We wouldn't have a very deliberate channel like this form. So that was showing me that this is clearly ready to sell off from here, statistically speaking anyway. So 1 hour time frame, this confirmed it again. So we've got extension structure here. So this is so clear. Move higher, continuation, exhaustion, breakout, get people caught on the wrong side, exhaustion back in, it dropped through, continuation down here, and then we refine that onto the 15-minute time frame. So if we now just draw this structure on here, so my original entry was actually there, and it was at night time. Yeah, it was at midnight. So swaps are around there, as you can see, 10 p.m. Swaps are then finished, and then this was the second bottom of the structure, which was evolved like so. 15-minute entry. Even on the 1 hour, it closed at the edge. Not that that's important there, I'm just giving you an example. But we'd come in, we'd close right at the edge. 1, 2, 3. Got involved here. And then, in fact, let me check my exact entry. Kiwi yen, so 88,759. So it's actually here. 759. And then my stops, from what I remember, we're at 10 pips. So invalidation area, very clear, nothing above it. Beautiful. So I got triggered in, and this was around midnight. So I literally just set the entry and went to sleep. And I was up at 5 or 6 the next day. So this did happen to trickle around, and it just kept me into the trade. And then it dropped through. And then as soon as I saw that in the morning, I break evened it. And then I just managed it accordingly throughout the day. We had a little structure point on the left, which we broke through, locked in aggressively. So I locked in above the low of the structure at that point, hence why that kept me in. So I must have locked in about 1.8, 1.75. And then as this dropped through throughout the end of the day, I got taken out here for about 3.53. It was just by a pip. And then this carried on like so. Again, I wouldn't have held through that, no chance. I'd never look back at these trades, ever. and think, oh, I should have locked in. How would I know that? That's when you start delving into guessing and gambling. So you got to stick by strict management criteria, strict entry criteria, and keep that consistent throughout. That's what's going to help you fulfill your edge in the end. Anyway, this carried on dropping, and it is where it is now. Regardless, I took my money, walked away. And to close this off, the reason why a lot of you might be looking at this and say, if you got involved in the same trade and thinking, oh, I should have just held it, or just this emotional nonsense, oh, I would have been running 20%. When you're trading a substantial level of capital, guys, you don't care if you're running 20% or 3%, because even 3.5% is a lot of money on scale. If you're trading $1 million, 3.5%, you've made 35k. If you're trading $500,000, you've made 17.5k. So get well capitalized. Focus on slowly scaling. Don't think about these home runners. Oh, I need to make 10% or 15% in a trade. No, that's cheap talk. Don't think like that. You guys want to trade like an institution, right? But you forget how an institution thinks. You forget how these traders think. You can't trade like that, number one. You never will do. You don't have the liquidity, you don't have the buying power, you don't have the systems in place. You just can't. You are a retail trader, no matter how you dress yourself up or how much you're trading. Regardless, you're always going to be a retail trader. You can dress it up how you like. But the one thing you can do is you can think how they think. You can emulate that trait. They're well capitalized, obviously. When you get well capitalized, do you really think you're going to sit there and think, oh, I've only made 35k this week, or I've only made 20k this week, or 10k this week, or 5k, whatever the amount is? Do you think you're going to have these overtrading tendencies if you've made a substantial level of money or profit on a trade? If you're trading that level of capital? No, you're not. You really are not. But to get to that stage, you need to have the correct mindset in the first place. That's why it's very, very important to understand what I'm talking about in this video and what I've mentioned over and over and over again. You can't just say, I'm going to start eating healthy when I get abs. It doesn't make sense. You got to start thinking like a professional trader before you're in the position of having that capital and making that kind of money. And then everything else fixes itself over time. So remember, this is why we have psychology programs. This is why we have Falcon and have the correct education. You'll never see me overcomplicating technicals. It doesn't need to be complicated. Once you understand the system well enough and sufficiently enough, everything else will look after itself. And then you've got the technical knowledge grounded. Then you think, okay, cool. I can't apply this now. I can't do it consistently. For some reason, I always jump the gun. I know exactly where I need to be getting involved in the market, where I need to be getting my entries, but I just can't discipline myself. I'm emotionally uncontrolled. Not everybody's born a disciplined individual. We're not designed to trade the markets as human beings. We're human beings. We're emotional beings. God's not made us to think probabilistically. We're emotional by nature. Fight and flight. That's just how we're designed. We are the worst candidates for trading the markets. So you have to train your mind to be able to trade the markets. System is one thing, but the application of that system consistently comes through discipline. Discipline's a trait, emotional trait. It's brought forth emotionally. Discipline. So no matter what you say, you're going to have to work on your mind regardless. Anyways, guys, hope you enjoyed this trade recap. And until next time, trade smart and trade safe.